Welcome, everybody, to our June 14th, 2011 co-production. Now, this is between FXStreet.com and FXDD. Very glad you're here today for our live education. Now, it's like a great I sat in for a little bit of it, so we're really glad to have James Chen with us now at FXDD. We've got another great presenter now coming up who is Greg Michalowski. I want to give you our disclaimer, though, first. It's that we do not give buy, sell, or hold recommendations. Trading is risky. You want to make sure you trade only with risk capital that will not affect your lifestyle. Okay, so today we're going to be talking about removing fear in your personal Forex trading. This is going to be a great topic. I think everyone's going to get a lot of benefit out of that. Here is Greg Michalowski on the left. He's our chief currency analyst at the company. Many of you know him from his speaking engagements around the world. You'll get a great training from Greg today. I'm Sean Powell. I'm the national trainer at FXDD. I've also been in the markets a long time, so I'll be helping out in the chat throughout this training. We've got a couple great things going on at FXDD right now. One of those is Race to Rewards. This is a program where you have a chance to win cash prizes and prizes just for simply depositing money into your trading account, which you need to do at FXDD.com. The other promotion that we have going on right now is for webinar attendees today only. I can get you a 5% funding bonus in your live trading account, and that can be new accounts or old accounts. The only thing is you have to have it funded within the next 7 days. Send me an email, spowell@FXDD.com, and I'll get you all the details on that. All right, without further ado, I'm going to switch over the role to Greg. Wish him good luck, and let's see what you got, Greg.
First thing I notice is the date is quite off here. It should be June 14th. That was the last webinar I gave at FX Street, which, by the way, might as well get in my thanks right now to the good people at FX Street. We didn't mean to corner the market here with FXDD webinars. My friend James Chen just recently joined our firm, and these webinars are well in advance, but you get a good couple hours here of FXDD material with some technicians. James, an excellent technician. I'm very happy to have him part of the team. Today I'm going to be talking about controlling fear, the Forex trader's worst enemy. Fear is a trader's worst enemy. And fear is something we face nearly every day, don't we? We face fear. Think of when you were growing up. The fear that I had when I was growing up, I feared early on in my life the dark. I feared the dark. I feared that someone was hiding in those closets, and I couldn't get myself over that fear. Later, when I grew up, I feared other things as a grown-up. And I want you to think back in your life and think of the throughout life we've all had our own sets of our own things that we're fearful of. Fear is derived from many things, but one main cause of fear, or probably the chief cause of fear, is the unknown. What is going to happen to me? What is going to happen to me? Think of in my own life, I have this fear of roller coasters. And what my fears, what is going to happen to me? Am I going to get hurt? Am I going to get maimed? Or am I going to die when I get on a roller coaster? I just have this fear that I can't get over. I also have fear on sports and athletic fields. In golf, am I going to hit the ball in the water? In skiing, am I going to fall down and hurt myself? In baseball, when I was growing up, was I going to strike out with the bases loaded? I had this fear, and I'm sure a lot of people also have fear in that sector of their life. In my public speaking, I fear today that I'm going to be a failure. Am I prepared enough for my speech? Am I going to forget what I have to say? Now, thank goodness for these PowerPoint slides. Will the audience be engaged, or will they be bored? My personal life fears. Am I marrying the right person? I've been married for 26 years, not to worry. Am I ready to be a parent? This is a fear that I had before I had had children. And am I preparing for my future properly? Finally, I have fear in my career. Will people like the book that I wrote? Will they like my presentation here today, or my presentations that I give regularly? And will I get fired? I think that's something that we all fear today. No matter what, how secure you may feel that your job is, we all have this fear that will I get fired? It's a difficult thing to get over. Will these markets find a trend again? I think that's something that we're all concerned about as the market goes back and forth between support and resistance. We have to deal with our fears way too much in our lives. It seems like we're constantly worried have these fears. And what I've noticed is how you react to your fear can actually magnify the consequences of fear. There are people who react to fear in different ways, and if you magnify that fear of the roller coaster, of what you may be doing in your speech, of your fears about your marriage or about raising children, oftentimes that magnifies your fear and actually causes more consequences as a result of that fear. For instance, should I actually stare at the water in front of the green when I'm facing a shot on the golf course? Or should I ignore it and just focus on the green? Should I worry, constantly about failing as a parent or a husband? Should I worry, honestly about the roller coaster flying off the tracks? After all, they don't fly off the tracks. They're built to stay on the tracks. They're built there to scare you. But they're supposed to stay on the tracks and keep the people safe. Should I worry about the market skittishness? Should I worry that the market may never, ever, ever trend in one direction or another, or we're going to be caught in these ranges forever and ever and ever? And what I found is that if you worry too much about these things, if you let them get at you, you're going to just do much worse. You're going to be much worse for wear, and you have to be able to find ways to control those fears. Most retail traders struggle with fear. Most retail traders struggle with fear. I've been in the retail foreign exchange business now since the year 2000, and I've talked to a lot of traders out there, and it's what I seem to find that there's just a lot of fear that traders cannot get over, and this fear causes them to not trade well. And in fact, I call fear the trader's worst enemy. It's part of my theme. In fact, I think of fear so intensely that I have fear as an integral part of what I call my trader's game plan. Those people who have listened to me in the past know that I start at a foundation. I have a mission statement, and my mission statement is to make the most amount of money with the least amount of risk. And my game plan is to trade trends and keep fear to a minimum. That's how I'm going to make the most amount of money with the least amount of risk, to try to focus on keeping fear to a minimum. And if I can do that, I think I would satisfy my mission statement of making the most amount of money with the least amount of risk. Fear causes traders to do things they normally would not do. Think of those times that you have fear in the market. What do? You tend to sell the lows, don't you? You get out because the market's going to go lower, and you just easily sell at that low. Next thing you know, the market bounces back. You'll buy the highs. This is the opposite of selling the lows, and sometimes you'll do the same thing or do the same mistake multiple times in a day. You'll sell the low, buy the high, and you just bang your head against the wall. You'll exit when you have good trade location. You'll end up exiting early. Why? Because you have fear. You have fear that the market's going to take away those gains from you, and so you exit early. You also tend to exit late. You have this fear that if I don't get out right here, the market's going to. I know it's going to continue, or it's going to turn around, and it's going to go my way. So what you do is you justify your fear, and you exit the trade late, and it goes the other way. And finally, the last thing that most traders who have fear, what it causes them to do is not trade. That's when you've done 1, 2, 3, and 4, and you finally get to number 5, and you're so wrapped up and so tense that you can't trade at all. And this is also a fear that traders have, and a consequence of the fear that you have. And so you have to find ways to get around that. And I have 3 reasons why traders have fear. And the first reason is probably the most obvious, And this is the fear of failure. We all have this fear that we're going to lose money, that we're going to fail, whether it's in trading or it's in everything else in life, that you're not going to do well, you're not going to be successful in what you do. So you have this fear of failure that the market's going to go against you. How many of you out there put a trade on and automatically you fear that that trade is going to go against you? I have done it. I've gone through it a number of different times, had to get over that fear of failure. Then you have, whether you know it or not, a lot of traders have what I call the fear of success. Fear of success. And how could you have fear of success, you ask? And what I've noticed a lot in trading is this scenario. And try to put yourself in this position. You go along the market, you have good trade location. Maybe the market has been non-trending for a while, going sideways as an example, and you buy a dip for whatever reason or against a level. Maybe it's a moving average, maybe it's a trend line, and the market starts to move in your direction. The market moves 10 or 15, maybe even 20 or even 30 pips from this non-trending range, and you automatically book that profit. You fear that the market is going to take away your success. You fear that profit is going to disappear. And although there's an old saying that no one went broke taking a profit, what I often find is that people that may be true on the surface, but what happens if that market continues to trend? Remember, we're in a non-trending period prior to this move, this 20 or 30 pip move. And so what do non-trending markets tend to do? They tend to transition into trending markets. And trending markets tend to be fast directional. They also tend to have ranges that are high, the low to high range are much larger than a typical non-trending market. So you get out too early in the trade, and what do? You sell the market when the market goes up 20 pips, and when the market's up 50 pips, what's the next inclination for you to do? Sell the market again. And when the market's up 75 pips, what's the inclination to do? Sell the market again. When the market's up 100 pips, what's the inclination to do? Sell the market again. So although you made profit on the first trade, you got out of that trade because you feared the market would take the money away from you. You end up psychologically selling through the trend the entire way. So I call that fear of success initially at the outset of the trade, something that if you're aware of, that you may have this fear of success. And so if you're aware of this fear, it allows you to, when you have good trade location and you have a setup that perhaps is leading into a trend type move, you stay with it. If you understand that fear, you stay with it. So be careful of what I call the fear of success, and I hope you understood that concept and how I explained it, that I get Tracy saying so true. I hope that you understand that this too is a fear that people have. A lot of people get out of trend moves really too quickly, and they trade against the trend the rest of the way, and that causes them to lose money. The final fear that why traders have fear is that if you take a look at the Forex market, I'm going to put up I'm going to take this off of my screen here. I'm going to bring up the foreign exchange, the market here in just a second. Hold on, and I'll explain what I mean by this. All right. Well, notice here the euro versus U.S. dollar, and notice the way the market is ticking. 83, 87.5, 35, blah, blah, blah. It goes back and forth and back and forth and back and forth. And what traders don't realize is that when the market ticks like that, what's going in your mind is this fear is developing because you have a trade on. Let's say you bought the market at 80, and the market is 86 now, or in the euro versus, the market's 84 right now, 84, 87 at the moment. Every time the market ticks, it's the equivalent of placing a bet on the roulette wheel and having the wheel spin around and for the market and for that wheel to come up in black. And imagine the amount of time that it takes for that bet, and I'm not equating foreign exchange trading to betting, but we know the feeling of gambling, or a lot of us do, at the casino. When you're at the roulette wheel, you make your bet, you bet black. The market, they spin the wheel, and the ball goes around and lands finally in the black cube there, or area there, and then they pay out the bets, and the process of that bet takes maybe a couple minutes from start to finish, maybe a minute, maybe 2 minutes, most likely 2 minutes. Well, in the foreign exchange market, and this is an important thing to understand, is that the foreign exchange market moves very fast. These prices right here are a bet on the roulette wheel. Every time the market moves from 82 to 81 to 83 to 84 to 84 and a half to 85 to 86 to 85 to 84, that's like a bet on the roulette wheel. And so your mind is moving at this pace. You're seeing the market move like this. And this is why a lot of retail traders, especially beginning retail traders, have this fear because it's ingrained in the market movement. The Forex market moves. And whether it's moving in a directional bias or just standing still between 79 and 85, really not moving that long, it's the number of ticks that it does, that happens, that causes you as a trader to actually have more fear. And that, I think, is one of the reasons why traders tend to click out for 5 pips or 2 pips when you have great trade location in the trade. And so traders have to be able to try to control that fear. The fear that a moving market, the foreign exchange market, is moving back and forth, is actually increasing your fear on every pip along the way. And so the more experienced traders are able to to recognize that fear and be able to control it. And that's I just wanted to make that fear also people aware of that type of fear. So let me get back to my PowerPoint here. So fear of success, and fear of the fear that because prices move so fast in the foreign exchange market, are why I think the main reasons why traders have Forex traders have fear in their trading. So how can traders, the next question becomes, how can traders face and overcome their fear? And I have two points outlined here. One is understand what is causing the fear. So I just went through that we have fear of failure, we have fear of success, we have the fear caused by a fast-moving market in the foreign exchange market. And so those are causes of our, those are the causes of the main causes of our fear as I see them. And so what you have to do is just be able to recognize them. And then you get to number 2, find ways to control that fear. If you can recognize that fear and recognize your fears, then you have a better chance of being able to control your fear. And that's the meat of the presentation here today. So controlling fear trading, one way that you can do it is by educating yourself. You people are here today, listen to James, listen to myself, listen to the other speakers that FX Street provides you on a almost daily basis here, are educating yourself. You're here for a reason. You're here to understand things about the foreign exchange market that you didn't know yesterday. Perhaps you didn't understand that fear of the fast-moving markets, what that causes to you as a trader. That's one way of educating. Perhaps you listened to some setup that James taught you in the last session that you didn't know about. By educating yourselves, you're able to get more confidence in your trading, be able to educate yourself so that you can control your fear, so that you don't have that fear of failure. They don't have the fear that you're going to lose money in your trading. You're more in control of your trading. You're more in control of your emotion of fear. And the other way you can do it, you can control your fear, is by taking positions that you are comfortable with taking. A lot of retail traders take positions that are too big for the account value that you have. I like to use a rule of thumb, and this gets into money management, that you should use. You should risk only 3% of your account value on your trade. Calculate it out. If you have $1,000 and you're risking 3% on your account value, that's only $30 in a $1,000 account. And you have to figure out ways that if you're going to risk 20 pips on that trade, how big is the position that I should take? If you have too big a position, oftentimes you're going to have too much fear, and you become uncomfortable with that. That increases your fear. So this is another way that you can control your risk. And the other way that I find that you control your fear is by defining your risk. Traders need to define your risk. All businesses define their risk, and oftentimes traders feel that, well, they don't need to really pinpoint to define your risk, and they don't know how to define your risk. And so if you do this, however, if you're able to educate yourself, increase your knowledge like you're doing here today, control your risk by taking positions that are more comfortable with, and then defining risk, what you can do is what I call diffuse your fear. That is, take your fear down a notch. Take it to the level where you're not focused on each of the pips. You're focused more on the position, where you're at, what your risk is, what your reasons for your risk are, and by being able to define that, you're able to control your fear. And this is important for all traders to realize. So how do you define risk and use what I call the least amount of risk? When you define your risk, what I'm trying to do is use the least amount of risk in your trading. Now, does that mean that you use no risk? No. It doesn't mean that you use, a minuscule amount of risk. No, it doesn't mean that you do either of those things. What I try to focus on is that you define your risk, but you try to define your risk by using the very least amount that you possibly can use. If you use the least amount of risk, you have a better chance of not only profiting at a multiple rate of that risk that you use, but you also are able to control your fear as well. So how do you do that? And one of the ways that some people do it is by using fundamental analysis, by understanding what the market is going to do, how it's going to where it's going to go, for what reason, and use fundamental analysis in their trading. And they think that is a way that they can control their risk to be able to keep their fear to a minimum. And what I say to them is not likely in the retail foreign exchange market. And the reason is that all these things here are what go into fundamental analysis and then some. There's economic releases, there's interest rates, there's fiscal policy, there's monetary policy, there's mergers and acquisitions, there's weather, there's war, rioting, politics, money supply, velocity, money, consumer confidence, on and on and on. All those things go into what I call the fundamental pot. And if our goal is to define our risk, and that way we can control our risk and then use the least amount of risk, what you'll find is that all these fundamental things that go in this cauldron and determine the price moving up and down are just too much for the human being, for a retail trader to control, and to be able to control your fear. Just take today and take the last few days in the market. What have we seen? For the first 3 hours of trading here today, I have a news service that squawks news items into my ear. It was grease this, grease that, ECB Draghi says this, U.S. inventories this, the retail sales that, PPI this, and it was maddening to try and figure out the effects of those fundamental news on your trading. If someone is looking at just those retail or those fundamental news, you're just going to go crazy with your trading. So what you as a trader have to do is probably not rely on fundamental news. It's just going to increase your fear and increase your risk. And if you are a fundamental trader, think about it and think the types of fear that you have. Now, am I saying fundamentals are not important? No, fundamentals are an important secondary tool. They're not a primary tool that you should use in your trading. I like to say that I base my decisions on or the fundamentals actually give me confidence in the trade, and so that's okay. And may perhaps give you direction, but don't base a trade because it doesn't define your risk. It doesn't tell you where you're right. It doesn't tell you where you're wrong. Retail traders are best able to define the risk and use the least amount of risk, therefore, by using of course, technical tools. Now, I use 3 technical tools in my analysis, and these 3 are purposely chosen for a reason. And there are some of the 3 simple technical tools that you may have that are out there for traders to use. One is the moving averages. I like to use 100 and 200 bar moving average. 2 is a trend line, and 3 are the Fibonacci retracement levels. And I'm not here necessarily to show you how I use those today in specific and why I use them and explain to them in great detail. What I am here to do today, however, is show you how these tools can be used to do things like define your risk and be able to keep your fear to a minimum, and also to use the least amount of risk. And so these three technical tools that I use have 3 advantages. 1, they define my risk. 2, they define trends, and trends are important to me. Why? Because trends are where traders can make the most amount of money with the least amount of risk. That's one of the problems. One of my fears now is that the market will never trend again. But what we know is non-trending markets tend to lead into trending markets. So actually, this is a good time for me because the market's non-trending. I know eventually it's going to trend. But the technical tools that I use help define my risk. They define trends, and they also are what I call unambiguous. That is, the trades give me a bullish or a bearish bias. They tell me whether I should be long, or they tell me whether I should be short. They don't tell me ambiguous things like fundamentals. Fundamentals are ambiguous trading tools. They tell me they tell me things that are true. That is, I should be long the market, I should be short the market, and these are what I call unambiguous trading tools. So again, my 3 tools would be there you go. The moving averages, the Fibonacci retracement levels, and the trend lines. And here's just example. We finally get to a chart here, and we're going to look at some other charts here in live markets here in just a second. But this is the dollar versus yen, and for the blue line in this chart represents my 100-day, in this case it's a daily chart, 100-day moving average. If you were to just use this tool right here, what would you, and the market was bouncing against this 100-day moving average, could you define your risk with a trade by using that tool, using that technical tool? And the answer is yes, you could. You could sell against that level right there. Why? Because it tells you that the market is bearish if the price is below, and it tells you if the market is bullish if the price is above. And guess what defining risk allows you to do in that situation? It allows you to diffuse your fear. It allows you to say, my risk is this much. It's if the market were to close or move 20 pips or 30 pips above this moving average line. That is my risk. And as long as you're using proper money management, you're using less than 3% of your account value, that you have the you believe in this moving average line. As long as you you're able to do these things, you are able to diffuse your fear and say to yourself in your mind and say, I know what my risk is. My risk is on this trade for a reason. I have the 100-day moving average, which I know is important. I know the market's been bounced against it once in here, and it's bounced against it twice here, and it's bounced against it 3 times at this point. The 3rd time it goes against that, and the market starts to move down at this point right here, you got to be short, right? You got to be short. That's the trade. That's what the technicals allow you to do, is be able to control your fear, to define your risk. If you can do that, you have a better chance of not being fearful of the market, of not being fearful that the market is going to take your money away or do whatever. And so once you're able to do that, now you start to anticipate a move away from that moving average line. So now this fear of success that traders have, where they take their 10 pips and get out of the trade, is probably less. You have less fear of success. You have more confidence in your trade. Why? Because you traded against the level that allowed you to define your risk, to diffuse your fear, and then the trade becomes managing the trade by using the same tools that I use, just in a different format. You might look at an hourly chart, you might look at a 5-minute chart, but the point is, you want to see you enter in the trade, you define your risk, you diffuse your fear, you control, and you're able to stay on the trend and allow your market to move in your favor to the downside. So that's an example of a moving average. Here's a 38.2% retracement. The pound versus U.S. dollar. I don't know how it's been end of December low price. Average 8.2 for 2 days in a row. moved above the 100-day moving average yesterday, and that gave a reason to buy the market, didn't it? You were able to define the risk by using the Fibonacci retracement line. You also could use that, by the way, down here at 50% retracement. The market originally went to the upside here. The market came down, found support against 50% retracement and this parallel trend line, by the way, and at that level. Traders could define their risk at that level. If you can define your risk, you're able to control your fear. If you control your fear, you don't have fear. You can diffuse your fear and allow yourself to conquer that devil, conquer that trader's worst enemy. So there's an example using the 38.2% retracement. Now let's look at the trend line here, and this is the euro versus US dollar. This is an hourly chart. This is how I had to set up. I chose to use this low right here. Sometimes the market overshoots. I like this slope of this line a little bit better. And then I put a parallel trend line on the top, across the top here. And the market in the New York session came down, tested that trend line, quickly rejected it, started to move back up, move back to the top side of the trend line right here, and is finding some resistance up here at the top side of the trend line. This is an example of defining your risk against trend line areas. We also have the 100-bar moving average getting in the way here, and the 38.2% retracement, which is kind of defining the risk right now as we look at the market here. And so by using these tools, you get to define your risk. And can you use other tools? Sure, you can use other tools. You can use but the tools that I like to use give you a definitive bullish or bearish bias. That is, if the price is below the line, look for a move to the downside. And if the price is above the line, look for above the line, look for a move to the upside. So I thought at this point, if there's no immediate questions, I go into taking a look at some of the other live charts to see where we stand and try to make sense of the live markets here. And give you a better understanding of how to control your fear by using these moving averages. So I don't see any. Why does your bid-ask time show 1917 seems incorrect? That's MetaTrader time. Boyke, that's 1900 hours from 5 p.m. last night. For those people who don't know that. That fact, the Forex trading day begins and ends at 5 p.m. New York time. If some of the charts that I will show here today, if let's say your daily 100-day moving average doesn't match up with my daily 100-day moving average, you want to probably ask your broker what's the end time that you use on your charts, and the 5 p.m. time is the beginning and end of the foreign exchange day. Some brokers may use Greenwich Mean Time. Some may use some other time out there for their trading end and beginning of the day, and that's going to be different than 5 p.m. So when you speak about 1900 or 1900 hours, I guess it should be. I think it should be. Well, I'm not sure what time it is, but it's likely that MetaTrader time. All right, so let me take this off here, and we'll get to my chart. The question is it simple moving average or exponential moving average? I use the simple moving average. I'm one who very much pays attention or trying to keep things simple in your analysis, hence the simple tools that I use, like moving averages, trend lines, Fibonacci, retracement levels. Those are the only three I use. I use 100 and 200. Why? Because that's what they'll say on CNBC, and I think most people follow those two moving averages. So I want to be along with the crowd. The simple moving average has the word "simple" in it. Plus, most people look at the moving averages as a lagging indicator, and you'll read that in every textbook on foreign exchange trading. I look at it actually differently. I look at the moving averages as a coincidence. The price tells me that the market is moving, but the moving average and the tools that I use tell me when to go long or when to go short. If the price is below these moving average, that says to be long. If the price moves above it, that says switch from being, or when if the price is below the moving average, it says be the short. When the price moves above the moving average, it says be long because the market should go higher. And oftentimes when the market breaks these moving averages or comes down, like holds the moving average here, you can see that we get a reaction away from it. When the market breaks it here, we get a reaction away, then we come down to it, and the trend line here move back above it. The market gets a reaction. So it's a I look at the moving averages not so much as a lagging indicator in the truest sense, like it follows the price to the upside. It is my decision tool for executing a trade. So I look at it as a coincidence or almost a leading indicator. If the market breaks or holds the moving average, I'm looking for it to lead to the upside, or in this case, this is the employment day, lead to the downside when the market, after the employment number comes up to the trend line right here, it leads to the downside. It breaks below that, and it gave me the clues to sell the market at that point. So anyway, here we have our euro versus and I guess the next part, so why don't I use the exponential moving average? I don't see a need to kind of look at the market, to weight the market in by using the most recent data. I also take the tack that if we have thousands and thousands of traders out there, that I can explain to those thousands and thousands of traders how to calculate and how to what a simple moving average is. And a lot of people, if I can't explain directly how to calculate an exponential moving average, except that it's a weighted moving average, I couldn't tell you how to calculate it. So for that reason, I think most people like to use the simple moving average as well. The question becomes hourly chart for entry, less fear. That's a good question, Ashgard. Not necessarily, and by that what I mean is, let's go back to the dollar yen chart. And in this case, we have the dollar yen trading against the 100-day moving average. And so do you have more fear because you're trading against the 100-day moving average, or is that still a same borderline level where you can define your risk as if it were on a hourly chart, like the euro versus US dollar bouncing against this trend line here? It's as long as you can define your risk against a level, against a technical level, like and a very visible level, like a trend line, like a moving average line, like a 38.2% retracement. To me, that for you as a trader, that defines your risk, allows you to control your fear, and it doesn't matter if it's an hourly chart or a daily chart. You're going to apply the same rules to it. If the price moves above the 100-day moving average in the dollar versus yen, the likelihood is that the market moves higher. So you'll get out at that point, give or take, 15 or 20 pips or something like that. You'll have your initial level of risk that you have on the trade, and you'll have your stop. You'll be able you accept that stop. You'll be able to diffuse your fear. It doesn't matter whether you're looking at the hourly chart or the daily chart. What matters is that you're able to define your risk for a reason. All right, and if you can define your risk for a reason, you have a better chance of then you can sit there and diffuse your fear. So this is the euro versus US dollar chart that we've looked at, and you can see here as we look at the market, we're kind of in between two different points here, and these 2 points are actually, we have all our three tools lining up at the same area. Is there any wonder why the market is stalling at this level? It's stalling at this level because it has the 38.2% retracement that's moved to the downside as one level of support down below. By the way, in the London session, we went up to the high. When we broke through that 38.2, we broke through the 100 and then went up to our trend line here, this parallel trend line here. We also have the 100-hour moving average. We have the trend line at the top. So this is this area right here. Can everyone hear me? John can't, but I think can everyone hear me? Just say yes. So this area right here is an area where you as a trader can define your risk. So you as a trader, what do you have a choice to do? Well, if you are bullish on the market, you want to see the market stay above the 38.2% retracement, right, don't you? If the market is able to continue to hold that 38.2% retracement, you can define your risk against that line right here. If it can hold above that level and stay even better, stay above the 100-bar moving average, guess where we're going? The next level to get through is this trend line. And once we get through that, we have the 50% retracement and the 200-bar moving average. That's our green line here in the chart. So this is the progression that you as a trader want to take. Does it mean that you have to take a lot of risk in this trade? No, not at all. What you can do is, if it's and it has over the last 3 hours stayed above the 38.2% retracement. We've over the last 2 hours pretty much stayed above the 100-hour moving average, which currently comes at the 144.70 level. But we remain below this trend line. So the market is battling back and forth, isn't it? It's battling between the bulls and the bears, the people who are selling, taking profit perhaps against this line right here, and those people who are bullish. So you as a trader, whether you have a bullish bias, or a bearish bias, have a level here where you can trade against. Does it actually mean that the trade is going to work out? No. You as a trader, are subject to market movements. But what you'd expect, and if you have a good level of support or resistance that you can define by using a technical tool, you're in most cases able to find that key level of support or resistance in the market that if it breaks above, you're likely to see a directional move in the bias of the break. If it breaks below, you're likely to see a directional move in the bias to the downside. So right now, the euro versus U.S. dollar has is in between support and resistance and has a choice to make. Now let's take a look at this chart going back a little bit over time, and we can look at other levels along here. We've already looked at this level here where the market held the 100-bar moving average and moved higher. What I like to do is put parallel trend lines. We have this trend line in place, and we could put in a parallel trend line across the top. And what happens when the market moves above here? It should stay above that level, right? So if you were to sell at this point right here, define your risk, try to control your fear, the market moves above, what are you doing? You're getting out. You're defining your risk. Your risk is limited. You're using the least amount of risk, and you have the potential to move to the upside. When the market fails at this level and starts to come back down, what are you doing at this point? You're getting out of your trade, and you're looking for further, or in fact selling the market and looking for further selling pressure to some sort of support level. And as long as you draw these trend lines, as long as they're visible, a lot of times in the market will find these and use these levels as support or resistance. I mentioned that this day where the market had the non-farm payroll report, what happened, or not, this isn't the non-farm payroll, this is the ECB meeting, and clearly the risks were increased going into that ECB interest rate decision and Trichet's comments. And what did the market do as soon as Trichet said they're going to use extreme vigilance? The euro went moving to the upside, and where do we find resistance against? The underside of this trend line which extended all the way back to this area right here where the market found support. And then the day before the Trichet comments, the market the interest rate meeting, the market went below it, found resistance against the level, defined the risk against this level right here. And as soon as the comments came out, extreme vigilance, the market went up to that level and then started to move to the downside. Now, do I expect that you were sitting there with an offer up there through, as the headlines are coming out? No. But what you as a trader can do is understand that that level was a key level. Understand that the 100-hour moving average was a key level. And when the market started its move and trek to the downside, understand that this floor for the week was a key level. And when the market started its move at either any of these levels along the way, that it turned the bias from positive to negative for the euro versus U.S. dollar and allowed you to define your risk, allowed you to execute a trade where you can control your fear and allow the market to move in the direction. When the market moved below the 200-bar moving average, we came right down to another support level. This level was taking these flows right here. This line came off of this low right here and this low right there. This trending line actually came in and defined our low at that point right there. While the market's moving fast to the downside, what does it do? It comes up to a support level. Markets like to define their risk. Traders like to define their risk against levels. If you can do that too, you have a better chance to be able to be successful as a trader and also be able to control your fear, keep your fear to a minimum, and if you can do that, you have a better chance of surviving in the market. Let's take a look at sterling versus or the euro versus US dollar. It's a 5-minute chart here today, and this 5-minute chart, it works. Other things we can define a nice channel here. Markets like to trade in the channel in the foreign in the euro versus US dollar. So you're able to, if you're looking to sell the market or next target on the upside, what you want to do is see the market move through this top trend line. You just define your risk. You define your areas that you want to go. You're able to control your fear. The sterling versus US dollar, we talked about the market moving against that 100-bar moving average. That worked nicely in the trade. Today in the off the hourly chart of the sterling versus US dollar, we were last week we were in this narrow trading range. You could define your trend lines along here, 1, 2, 3, 4 different points. When the market fell through this level last week, the market used that level as a resistance level. Traders are able to define their risk against that level, being able to control their fear. They can control your fear. You have a better chance of staying with the trend. The market moves sharply to the downside, broke for a support here, moved all the way to our low at this point, which, by the way, was the 38.2% retracement line at that point right there. And so it found its way from an hourly chart, breaking through a trend line at this point, all the way down to the point where the market found support against 38.2% retracement. This is one of the other reasons why I like to look at multiple charts in my analysis, allow myself to get to those levels. On the way back up to the upside, the market found resistance today, a reason to sell against the top underside of this trend line. Oftentimes a key level that is broken on the way to the downside. Keep that line in place. A lot of times traders, especially on a corrective or a sharp move that we've seen over the last few days, are always looking for levels to sell against. It provides a borderline level, a level where you can define your risk. So are there any other currency pairs that people want to look at? We're coming to the end here, or any other questions that people may want to that have in regard to the presentation. The key point here, folks, is that you do have a lot of fear, and you have to control your fear by defining your risk. If you're a fundamental trader, you can't necessarily define your risk by looking at the news that's coming out. You'll just drive yourself crazy. But you as a trader can filter out that news by watching the price and using tools that allow you to define risk. And if you can define your risk, control your fear. So any questions out there, or any currency pairs that you want me to take a look at here, I'll be happy to take a look at. All right, what do we see? What do we see in the dollar versus Swiss here? This is an hourly chart of the dollar versus Swiss, and we know that there are trend lines that go from highs, that connect highs to highs and lows to lows along the way. And what I also put in is what I call remembered lines that are at key levels that the market finds either key, resistance or support at on a number of different times, or maybe just at a singular time. For instance, the market moves sharply to the downside. I'll put a horizontal line at that low right there, and oftentimes the market will come down, come back, and remember that line, and come back down, and come up, and it hits the 100-hour moving average at this point right here, and hits this line right here. And this is what I call a remembered line, a horizontal trend line at that point. And the market moves down and comes up to the 100-bar moving average, and moves down and comes up to the 100, and moves up to this trend line right here, and then breaks through the top side. And we move up 38.2% retracement. This move to the move right here, and stops at that 38.2, and then comes down to the 100-bar moving average right here. All these are lines that are very simple, just logical lines that you can put in the chart. So where do we stand now? Well, we found support last night against this old line right here, where the market had You can count the number of times we came down to a low here. We came here. We used this level. We moved away from that level. We found support. Moved a little bit below it here while it's in this consolidation. But look, found support against this area right here. Found support against this level yesterday and here today. Again today. So this is a reason to be bullish on the market at this point. You can define your risk down here. Use this as your stop loss at the level. When the market breaks through the 100 and 200 bar moving average, we start to look at our 38.2 or 50%. Where do we stop? We stop at this old high right here. Now this high was breached on, yesterday at this point. And what would you think at this point? That the market should go higher. So if you as a trader were putting on a trade as the market moves to that level, defines your risk, and the market didn't go higher, what do? You get out of that trade at that point and start to move. It moves to the downside. You don't wait around long. You try to use the least amount of risk when you're able to define your risk against key levels. So right now, just like the euro versus US dollar, which is stuck in between support and resistance, we're getting that New York session where the market has support against 50% retracement. And if I put a Fibonacci probably from this low to the high, but the key level is to get, if you're bullish on dollar Swiss, to get above there. Off the daily chart, we have room to the upside here. I have trend lines here. We are, we are showing some positive signs here. Bouncing off this floor here is a positive sign. Getting above the 100 and 200 is a positive sign. But what do we need as a trader? We need to get through these levels right here in order to push the market further to the upside. So right now, the dollar Swiss, I'd love to see the market move above the 84.52 level and get above the high from yesterday. And then there's a lot of room just to have a normal correction that would take the market up to this trend line. This trend line has gone all the way back to the beginning of the year. So this is a nice solid trend line here. That level comes in at the 86.51. But so if you want to be lean against here today, well, you might use the 50% retracement. The thing you may want to use is the 38.2% retracement on the 5-minute chart, which also corresponds with the 100 bar moving average. Dollar versus Canada, that is a horrible currency at the moment. It's been for a while now, but we did have a break here to the downside, and off the hourly chart we came right down to our this bottom side trend line. We put it, have a nice top side trend line here, and we defined a parallel trend line at this point. The market moved a little bit below that level, but finding some buyers down here. So we're finding some buyers in the dollar versus Canada. Can you define your risk against that trend line? Yes. If you're looking to buy the dollar versus Canada as a trade, you can define your risk against that borderline level. Keep your fear to a minimum. Understand your risk. Do you anticipate sellers or profit takers to come in at the dollar versus Swiss at the 84.66 level in the dollar versus Swiss? Well, you know what? Right now, if the market is holding that level right there at the 84.66, if I sold the market at this point, tempting the market to go through that level. Well, here's the thing. Even as a trader without a bias, you can use this borderline level as a level to sell against, and simply if the market moves above it, we should see momentum through this level. Now that momentum has to carry us through the high for the week, and that'll give us confidence for further moves to the upside. But if you're a trader, you should be, and you don't have a bias, what you're looking for is a momentum break. Now, do I think that the dollar versus Swiss franc, from a, would I rather be long or short at this time? If I am long, if I go long at this high, at the high right here, I'd probably keep a close stop below this 50% retracement line, maybe below these highs right here, in anticipation that hey, the market is if the market can't get through this level, we're going to find the sellers that are going to come in. We've been here for 4 or so hours here trying to test this top. So if I were to buy this market at the top, I would keep a tight stop on the position, look for the breakthrough, and move to the upside. If I felt inclined to sell the market and the bias and the longer term bias is to the downside, I would put my stop above here as well. It's kind of half a dozen of one, six of another. When the market does this non-trending type thing, you have to respect the ranges until it says otherwise. If the market were to break, and this is count the number of days, 1, 2, 3, 4, 5, 6, 7, 8, 9, 9 days here in this narrow trading range. If we break above here, we should see the market find some momentum, find some reason to move to the upside at an accelerated pace. And by the way, we have an S&P interest rate decision coming up, so that may be a reason. But oftentimes it'll happen before the meeting. So, we may see, I would not ignore a move above this ceiling here, above this high here. That's where I think the market would go. So it's a key point here for the dollar versus Swiss. I can say that again. And I think we're running out of time, but you give me the high sign of Dinda or Vicky or Maud. The Aussie versus U.S. dollar. What did we get last night? We get the Chinese interest rate or reserve requirement increase, and we see the Aussie versus U.S. dollar move to the downside. And as often happens, they're like, we're the tighten credit. Well, okay, so that's going to slow down growth to Australia. And then they're like, well, wait up, they're tightening because things are going really well in China and they're still growing. They want to slow down just the excess growth that's happening, so you get this surge to the upside, and their economic data at China was better anyway. So it moved to the upside. Where do I see a reversal soon? If you're looking for a reversal, Mariano, this is the point to lean against right here. We have a channel here defined by using these points right here and this point right here. So if you have a bearish bias and looking for a reversal or an area to sell, you as a trader can sell against this top side of this pretty steep move to the upside here at around the 107.13 level. If the market breaks above that, get out of the trade, because what we know is trends are fast, trends are directional. What we've seen here in the Aussie versus U.S. dollar on the daily chart is a lot of sideways action here. Note here that the market has held more or less a 38.2% retracement of this move to the upside. We got a little move down here, a little move down here, a bigger move down here, but I'm sorry, I'm looking at the wrong line. Right here, 38.2, hold it, moved a little bit below it, failed, moved a little bit below it, failed, moved a little bit below it, failed, held it. So the fact that we're holding that 38.2 is bullish from this standpoint. Don't fall asleep because we've been in this narrow trading range. So what I mean by that, don't ignore a move above these highs right here in that currency pair. All right, well, it's 12 o'clock or 1 o'clock my time, and I want to thank you all for coming in. Thank you to the people at FX Street. And if you have any questions, you can send me an email at greg@fxdd.com. If you want these slides for whatever reason, you can also send me an email at greg@fxdd.com, and I'll be happy to send them to you. I believe the people at FX Street are taping this along with my colleague James Chen, so you have two for the price of one here from FXDD.